Good morning. My name's William Franklin. I'm a partner in the share scheme specialist Pett Franklin. And the topic of today's webinar is employee ownership trusts, EOTs, specifically in the context of them being a new exit route for retiring entrepreneurs. I think this is a relatively new area and a very interesting one. So I'm hoping today to touch on some of the issues, but there are many more issues than the ones I'm going to be able to cover this morning. So if you're interested in extending the dialogue further, by all means email me after the webinar with any points you'd like to raise, and I'll see if I can deal with them. Anyway, let's begin with imagining that you were an entrepreneur. You had a business that you'd built up over a number of years, but you are now looking ahead towards retirement. And the question then is, what do you do with the business that you have built up? Now, one obvious solution is if you have family members who wish to take over the running and ownership of the business, then that is an obvious solution. It's a very common solution, particularly in continental Europe, but less so in the UK. And of course, there may not be a member of the family able or willing to take on that new role. So if you can't transfer the business to the family, what are the other alternatives? Well, if it's large enough and profitable enough and has good prospects, well then potentially it might be a business that could be floated. But that of course is an option, an IPO, which is only open to a limited number of companies. Another possibility is to sell to a third party, a competitor maybe, or possibly a business backed by private equity. That, of course, does involve something fundamentally happening to ownership, a change to a new owner with new objectives, new criteria. And it's often the case that for your employees, it doesn't always have a necessarily long-term happy outcome. So very often people look as an alternative to sell to the management, an MBO. And that, of course, is still very common and popular. But of course, if we're talking about a successful business that's got significant value, selling to the management isn't always that easy because they may not be able to afford to pay a reasonable price for what the business is worth. So if none of these options are open to you, what else can happen? Well, sadly, and this happens in far too many circumstances, the business is gradually wound down. It loses momentum, the owner loses interest, and eventually it stops with the loss of employment and the loss of all the other benefits of having an active business. So is there an alternative now? Well, I think the EOT, the Employee Ownership Trust, undoubtedly is a new alternative. It is, in the sense, the new form of management buyouts, or at least a new variant on them. The basic idea is that you sell the company, or at least a majority, control to a trust set up under the legislation introduced in Finance Act 2014. This legislation is intended to mirror, as far as possible, the structure of the John Lewis partnership and the way that is owned. Now, of course, the trust will have no money of its own. So anyone who sells to an EOT has to be patient. They have to wait until the company has generated or been able to release sufficient cash to the trust to allow the trust to pay off the consideration for the shares. So these models generally involve some form of what is known as vendor finance or patient capital on the part of the vendor. One of the things that changed with the legislation in 2014, however, was that if you sell your shares to a trust and it's a majority of the shares at the time, then that sale is tax-free in the sense of there being no capital gains tax on the sale. That's a very considerable incentive, because even if you are benefiting potentially from entrepreneurs relief, you would still have, normally if you sold to a trust, a dry tax charge. But here the dry tax charge doesn't arise because the disposal to the trust, providing it's a Finance Act 2014 one, is tax-free. There's another very important tax incentive which the government has permitted to encourage more EOT-owned companies, which is that if the company is owned and controlled by an EOT trust, then the employees can receive bonuses from the company up to a maximum of £3,600 each year, tax-free. In a sense, EOT companies now permit tax-free profit-related pay. I've talked about control being transferred to the EOT, and that is crucial. We are talking about control, the majority of the shares being owned and controlled by the trust. Often people sell 100%, but it isn't necessary to sell 100%. It is possible to have hybrid structures whereby majority, 51% or more, is sold to the EOT. But the founders, the owners, continue to hold a minority interest afterwards. There are other possibilities as well. Employees can receive free shares or buy shares potentially under the very favourable tax advantaged share incentive plan. It's also possible for options to be granted under EMI options. This is a little bit surprising because, as we'll explain later, the EOT is normally structured so that there is a corporate trustee rather than individual trustees. Normally, having a company controlled by another corporate vehicle would mean that SIPs and EMIs are barred. But when the legislation was drafted, it was anticipated that there very often would be a corporate trustee. And so there are specific exemptions in the legislation from the normal rules on independence that would otherwise have prohibited the use of SIPs and EMI. So it's a good example of someone thinking ahead when this legislation was originally designed. At the heart of the EOT legislation is a somewhat unfamiliar concept, although it's one that John Lewis and other companies that have modelled themselves on John Lewis have used for many years. It's the concept of indirect employee ownership. The shares in the trust are being held for the long-term benefit of employees as a whole, not, as is normally the case with employee share trusts, as a sort of warehousing temporary arrangement. The purpose of this, ultimately, is to give collective indirect ownership to employees. That comes at a price, in the sense that the employees also need to take on collective responsibility in the long term once any transitional period with the former owner is over, for the actual running of the business. So the employees are getting something very valuable, but it comes with a responsibility as well. The possibility of using hybrid EOTs, where there are shares operating with direct ownership, does open up the opportunity to have the best of both worlds, direct and indirect employee ownership. And through that, it might be possible to incentivize managers through equity without requiring an ultimate third-party exit. How then does the structure of an EOT work? Well, in simple terms, the company is owned, or at least a majority of it is owned by the trust, the EOT. And then the trust is controlled by the trustees. Now, these can be individuals, but generally speaking, that's a bit of an awkward arrangement, because when something happens to an individual, you have to replace them. The norm is for the trustee to be a corporate body, and for that corporate body's directors to effectively be the trustees. So what we have is something that is beginning to resemble a two-tier board structure. Because we have at the top a corporate vehicle which is acting as the trustee for the long-term interests of employees. Its role is that of a shareholder, not a manager. But it may well be the case that amongst the directors of the trustee company, there will be employees. The legislation is relatively flexible and adaptable to circumstance. But since we are talking about a company that is owned by a trust for the long-term benefit of employees, it seems natural that at some point in its life, employee representatives will be on that board, elected or appointed in some way to be determined. So we start to see with this structure employee directors. Now, this is a concept that has been talked about in the UK a great deal recently, but very little has actually happened. On the continent, it's very common, but it's in the structure of a two-tier supervisory board. In the UK, the use of the unitary board as our normal structure has tended to be a deterrent from involving directors, employees as employee directors. But potentially here we're seeing the emergence of something that could mirror the German structure. One of the questions that often arises with an EOT is, how is the price at which the EOT buys the company from the existing owners determined? I think it's just worth stepping back for a moment and remembering that what we are talking about here is a sale of the company by its existing shareholders, or at least a majority of those shares, to a trust. So we have fundamentally a sale transaction. But it's a rather unusual transaction in the sense that there isn't an outside third party making an arm's length acquisition. So how is the price determined? I think you have to be careful here to be aware that there can be very simplistic thinking. And I think a reasonably sophisticated thought process is required, bearing in mind that the company is being sold to a vehicle, the trust, which has no money. And that ultimately its ability to pay any consideration that it agrees to is wholly dependent on the company generating sufficient cash and profits in the future in order to pay off that consideration. Unless the company makes a successful transition to being an employee-owned company, it simply won't be able to fund that consideration. So we're talking about a price that is dependent on future profits and uncertain as to whether it will ever be paid because of the uncertainty as to whether the transition to employee ownership will be successful. So as I said, I think simplistic approaches to valuation potentially lead to misleading outcomes, and this is an area that needs a lot of thought about. There's also the question of the inland revenue. Now, they don't get immediately involved, but if you have the prospect of hybrid arrangements where there are EMI schemes or SIPs, then HMRC do have an interest in the value. There we're talking about relatively small minority holdings, and there's a question then about how one should value such shares in the context of an EOT. If you start to think about the structure of an EOT, it is inherent that there will be conflicts of interest. Just think about the position of the former owners. If it's a hybrid arrangement, they will be continuing to be shareholders, albeit minority shareholders. So that will be one interest that they have. If, as is likely, the price that the trust agrees to pay for these shares cannot be paid immediately, but may have to be deferred or delayed or contingent over what could potentially be several years, then the former owners are also acting in that capacity as lenders in the form of vendor finance. It's unlikely that they will, or that possible, immediately cease all involvement with the running of the business. And it's quite possible that some will wish to continue in a role as a director of the operating company that's been sold. So there's another potential role that they have. And of course, who are the trustees? We've talked about the fact that employee directors may be amongst the board of trustee directors, that it's quite possible there'll be other outsiders as well. But the former owners are not prohibited from being directors of the trustee company as well. And they may well think that it's useful for them to have a role in that capacity. So it's not difficult to see the former owners having at least 4 different hats to wear at the same time. So conflicts of interest are inherent in the EOT model. In some senses, setting up an EOT is a bit like a conflict of interest minefield. It's not something to walk into without at least a decent map of where the mines are planted. I've already talked a little bit about employee engagement, but I do think this is a very important issue. And there tends to be a lot of focus with EOTs, inevitably, on the generous tax reliefs, and they are important, but one needs to keep them in their proper context. They are there to oil the wheels of an EOT transaction, to give owners a new incentive to look at this as an alternative to the other possible exit routes we discussed earlier. But it's important not to overlook the fact that if you do sell a company to an EOT, something fundamental has happened. Ultimately, the keys of the castle, by which I mean the company being the castle, the keys of the company have been handed over to the EOT. And who is a director of the EOT, and whether employees are part of it and how they're part of it, is a really central question. And it's important, I think, long term to address, because it is through that route that employee engagement and the benefits of a company being employee owned are partly delivered. Finally, I'd just like to talk a little bit about tax. There's a number of issues here, and I'm just going to be able to cover just a few of them. First of all, the trustee. Now, so far, we've been looking at the context of a EOT buying the majority of this company from the existing owners. That does not prohibit later on a third party coming along and seeking to buy the company. But of course, the trust, the EOT, would need to agree to that. And they ultimately would have the final say as the controlling shareholder. So let's imagine that situation did arise and there was a sale. The majority of the proceeds would then go to the trust. When the trust distributes the proceeds, it would do so in accordance with the trust deed, and the likelihood is that the trustees would find some basis of distributing those proceeds that was considered fair and equitable for all the employees. Simply concentrating those proceeds on a few individuals is unlikely to be something that the trustees would feel able or wish to do. So what it will mean is that those proceeds that are received will be distributed to employees, and those will be taxed as employment income. So while a sale to an EOT by the founder is highly tax efficient, and the ongoing existence of it is also highly tax efficient for employees in the form of tax-free bonuses, an exit starts to become much less tax efficient because we don't have a CGT disposal for the trust in terms of the distribution of the proceeds. We have taxable income being generated. And in fact, the tax position can be significantly more negative than that. The legislation permits trusts to be onshore or offshore. Now, if they're onshore, then the proceeds that are distributed will be after the trust itself having to pay capital gains tax. If they're offshore, well, depending on the jurisdiction, but normally that means the actual disposal of the shares is not subject to capital gains tax, although obviously the subsequent distribution of the proceeds is subject to employment income. So at the moment, there is a tax advantage if there were to be a subsequent disposal, but of course that's not the purpose by which these things are set up and not the intention. There is a benefit from being offshore. Raises a few questions having an offshore trustee. It doesn't make it particularly easy for employees to be involved in such an arrangement, which rather goes against the whole principle of it being an employee-owned company. Also, the issue of Brexit may become quite relevant. Why does the government allow offshore trustees for EOTs? Well, apparently the reason that's being given is that to do otherwise, to simply limit the trustee to being a UK trustee, would be in breach of the rules of the EU in respect of the single market. Jersey, by the way, and the other Channel Islands are themselves part of the single market, even though they are not part of the UK. So it was considered to be discriminatory if they were not permitted to have trusts offshore. Obviously, when Britain leaves the EU, imagines that this is an issue that might be revisited by a future government. We often loosely say that the sale of shares to an EOT is tax-free. That isn't quite true, because the sale of shares, the purchase of shares by the EOT, is subject to stamp duty. Now, this is a fairly small amount, but it's calculated normally on the entire sale proceeds, which might well include a substantial element which is deferred, contingent, and uncertain. So that can seem a bit harsh, to be paying upfront stamp duty on monies that may never be actually paid. That looks like a mistake in the legislation, which it would be nice if a government could remedy. A remedy could be fairly simple. But for the time being, there is that problem. Another thing that is worth just remembering with a sale to an EOT is inheritance tax. Now, when a private company is passed to within the family, there is a provision in the inheritance tax legislation to protect that transfer from inheritance tax. I mean, if the value of the property was included in the estate of the deceased, then a significant amount of inheritance tax might be payable on the transfer, which would probably force the sale of the company and mean that it couldn't be transferred to the family simply because of inheritance tax. So there's a specific relief in the inheritance tax rules to protect family-owned companies called business property relief. Now, if someone sells a company in the normal way and then has proceeds, well, of course, those proceeds are not subject to inheritance tax relief through business property relief. So maybe that's just fine. That's just the way it works for everyone else. But there is an issue, I guess, with EOT-owned companies where the sale has yet to be completed, in the sense that the full proceeds have yet to be paid or may not be paid, and outstanding consideration in an EOT sale does not benefit from business property relief. Again, maybe that's a mistake in the legislation. The legislation was quite far-seeing in providing an exemption from the independence test for SIPs and EMIs. It's a shame that it wasn't as far-seeing in business property relief as well. Hopefully, at some point, a government might remedy that defect. Finally, just one other area of tax I'd like to mention. When the owner sells their shares to the trust, that consideration that the trust pays might be in the form of loan notes. I mean, that's quite a natural thing that one might expect to happen. But there is a potential problem here. Remember the likely structure of an EOT being that above the EOT there will be a corporate trustee. So the corporate trustee will ultimately be issuing, because the EOT has no legal personality of its own, it acts through the trustees. That corporate trustee would, if loan notes were issued, be issuing loan notes. Now, in the capital gains tax legislation, there's provisions under what are known as Section 135, which says that where you exchange shares for another form of paper issued by a corporate body, there's an automatic rollover, i.e. you don't pay capital gains tax at that point in time. Now, normally that is exactly what you want to happen, because you don't want to pay capital gains tax on a dry disposal. You want to defer it until you actually have the proceeds, which is what 135 does. But if you look at the legislation, of course, the problem with a sale to an EOT, if the EOT issues loan notes, is you're still within 135. Now, at first sight, that doesn't seem like a problem. You're not paying tax, are you? But what you've done is you've created a disposal because of the loan notes, which takes you out of capital gains tax for the time being, but also takes you out of the EOT reliefs. So potentially you lose ultimately the benefit of the tax-free sale to an EOT. So there are different views on this. There are views that say that because trusts are strange creations that go back to the Crusades and EOTs are controlled by the trust, but it's a foggy situation, that this section 135 doesn't apply. There's another view that says, well, Parliament couldn't have intended loan notes not to apply. Where's the mischief? And that seems like a valid point, that there probably isn't a mischief, and Parliament, if it had thought about it, probably would have given an exemption in the same way it has done for SIPs and EMI independence tests. But a plain reading of the legislation does seem to give rise to an issue. So I've tried to cover a few of the areas that are relevant in EOTs. As I said, we've been doing quite a few of these recently, and I would say they are one of the most interesting and complex areas of share scheme work that there is. And it's not an area that one wants to approach without quite a bit of thought and attention. If you've got questions, I'd be very interested to hear them. I think, as I said, my email address is below or on the slides, and of course you can contact me at Pett Franklin, where the website gives my email address. So I'd be very interested to any other thoughts people have, and thank you very much for listening.